the reality now is that we can no longer ignore how much financial conditions have eased since the December 13 FOMC meeting. We have seen the stock market reaching new all-time highs, of course, every day at the moment. As we know, we're seeing credit spreads tighten a lot in investment grade, in high yield, in loans. We're also seeing IG issuance in January, and now it looks like in February also would be the highest January and highest beginning of the year that we have had ever in history. High yield issuance has been strong. Loan issuance has been strong. On top of that, IPO activity has been picking up. M&A activity has been picking up. It really is not surprising with this significant rebound in capital markets activity that the employment report for January was strong. And it is really also not surprising that the inflation data also was strong. So the bottom line is, I think that the market now has to realize that the data is just not slowing down, and the Fed pivot has given an additional tailwind to the economy and to financial markets and financial conditions and to capital markets. And all that is likely to continue to be supporting growth in consumer spending, in CapEx spending, in hiring for most likely the better part of this year.
Is there a scenario for you where the Fed actually hikes rates in 2024?
So I know Larry Summers and several others have been talking about this as a possible scenario. I do think that they would be reluctant and very reluctant to do that. But I do think at the same time that it's clear that the market has, on the back of the Fed pivot, declared victory and said that inflation is no longer a problem. And the problem is that inflation is indeed looking like it's becoming a problem again. You're having, obviously, average hourly earnings is in the range of 4 to 5%. This has to come further down. This is not consistent with the 2% inflation target. If you look at the NFIB survey, both for wage expectations and selling price expectations, they are all beginning to go up. And finally, you also have a number of other indicators that are leading in terms of what inflation is doing, and all those continue to point, in particular, we look at some of the underlying trends in the trim mean and the median inflation, to also more upside. So the conclusion is we are simply not done fighting inflation.
S&P 500 at 5,100, and the NASDAQ up 0.3%, doing better than futures. We've been open for 11 minutes here, Wall Street time. Torsten, the hallmark of your work at Deutsche Bank and now at Apollo has been a holistic approach to economics. What's the character of our nominal GDP? Everybody, not everybody, near everyone's got it wrong. What's the character of our animal spirit out 2 and 3 years?
I think this is a really important question, Tom, because as you just said, first of all, let's think about and let's evaluate our own, meaning the market's ability to forecast things going into 2023 and 2024. In 2023, everyone everywhere, including most likely also the Fed forecast, the consensus, the market was saying we will have a recession, and we turn out to not have a recession. The continued strength in the economy surprised everyone. This year, everyone came in and said, oh, the Fed will cut rates 6 times, maybe even 7 times at some point, because we will get that slowdown. And now we're sitting here a few months into the year, and the economy has simply not slowed down. The employment report in January at more than 300,000 jobs created was just really, really strong. So I think a very important dimension to your question, Tom, is that the U.S. economy is just incredibly diversified. It is really difficult for the Fed to cool things down. It has turned out to be that the consumer is much less sensitive to rate hikes. Corporates are less sensitive to rate hikes. So as a consequence, the diversified economy continues to do well.
And the scale of it, folks, I think the media, and I'm guilty of this as well, does a terrible job of showing the size of the American economic experiment versus other nations. We're on Apple CarPlay. We're on YouTube. Type in Bloomberg Podcasts. We've had a huge response to YouTube. Paul and I are humbled by it. Lisa's not humbled by it, but Paul and I are humbled by it. And there's a live chat there where someone just told me their mother threw out their varsity jacket and they've been in therapy for 30 years. Why don't you continue with Torsten Slok, his important research note this morning?
Absolutely, Tom. We are speaking with Torsten Slok, Apollo partner and chief economist. Torsten, just from an optics perspective, not an economics perspective, but from an optics perspective, how difficult would it be for Fed Chairman Jay Powell not to cut rates this year after, I don't know, strongly hinting in December that that was going to be the scenario?
Yeah, I know. But, I mean, I think that the markets have been over-interpreting what the Fed actually has been saying. He was at the press conference in December actually reasonably balanced. He was just saying that, well, for now we're on hold, and this was certainly the clear message. But more recently, several FOMC members have been coming obviously out and saying, well, maybe we do need to stay higher for longer. So with that backdrop, I actually don't think that it's quite simple for the Fed to just continue to say, well, maybe the risks have now tilted more towards some more upside risk, both on both sides of the dual mandate, both when it comes to employment and when it comes to inflation. So on that front, I think that the Fed communication challenge is actually much more straightforward relative to the significant roller coaster that markets have been through, from first, again, pricing 6 or 7 cuts to now pricing 3 cuts. And maybe as the data, again, we had jobless claims that were strong yesterday. We had inflation ticking up a bit higher yesterday on the month-over-month. All that would make the market where a lot of the action and a lot of the movements needs to be.